All right, let's dive right in. Welcome to the Stock Due Diligence Explainer on JBG Smith, ticker symbol JBGS. Now, this is a real estate investment trust, or REIT, that's making some genuinely bold and honestly pretty fascinating moves in what we all know is a really turbulent 2026 real estate market. What makes JBGS so compelling right now is their overarching strategy. Get this. They're actively selling off their multifamily assets, the apartment buildings, to acquire distressed office properties. Yeah, you heard me right. They are literally buying up office space in 2026. So we're going to crack open their recent SEC filings and earnings reports to see if the math actually backs up this wild contrarian play, or if they're walking right into a massive trap. To figure that out, we're structuring this explainer around 5 key areas. We'll start with their footprint as the national landing landlord, run through their financials and valuation, unpack that big strategic pivot, take a look at dividends and ESG, and wrap up with future catalysts and innovation. All right, kicking things off with part 1, the national landing landlords and how they are dominating DC real estate. Operating as a mixed-use REIT, JBG Smith manages an absolutely massive portfolio. We're talking 39 total operating assets here, 15 multifamily and 22 commercial. Altogether, they command roughly 12 million square feet. That is a huge footprint, and it's heavily concentrated in these amenity-rich, transit-connected submarkets. The absolute crown jewel, National Landing. That encompasses Crystal City, Pentagon City, and Potomac Yard, literally right next door to the Pentagon and the nation's capital. This incredibly deep, localized concentration is their core competitive advantage. It's essentially a massive geographic moat. Moving right along to Section 2, Financials and Valuation. Let's take a hard look at the numbers. Now, to really get this play, we have to understand their current financial footing, especially since her stock price took a nasty 24% nosedive in the year leading up to July 2026. As of that date, JBG Smith is sitting on a market cap of around $1.11 billion. That puts them firmly in the small cap equity REIT space, trading at around $14.45 a share. To put that into perspective, this is a staggering drop from just a few years ago when their market cap was hovering over a massive $4 billion. So as an investor, you've got to approach a haircut like that with caution, sure, but also with an eye open for a potential bargain. And this right here brilliantly illustrates their current valuation. Take a look at these trading metrics. They've got a price-to-book ratio of 0.74. What that essentially means is the broader market is pricing them at a significant discount to the literal on-paper value of their real estate. Like why? Well, look at the leverage. They're carrying a net debt load of nearly $2.48 billion, which gives them a net debt to annualized adjusted EBITDA ratio of 12.7 times. Their enterprise value to EBITDA, which measures their total valuation against cash earnings, is sitting at 18.19x. But despite that heavy debt anchor, they are still generating real cash, pulling in a core funds from operations, or core FFO, of 42 cents per share in the first quarter of 2026. So how does all that translate to their recent performance? Well, despite the heavy debt, their trajectory is actually showing a surprising amount of resilience. If you compare Q1 of 2025 to Q1 of 2026, their net loss narrowed significantly, dropping from $53.6 million down to $23 million. At the exact same time, their Q1 2026 adjusted EBITDA actually hit $48.8 million, which is up from the previous year. So the core business operations are tightening up, and they're trimming those losses, even while the broader market has been punishing their stock price. Which brings us to Section 3, the big strategic pivot. We're talking multifamily pain to office gain. Before we get into what they're changing up, let's look at their existing foundation. Their commercial office segment is anchored by some massive, incredibly reliable tenants. Based on Q1 2026 data, the U.S. government makes up over 26% of their annualized rent across 30 leases. I mean, they are the absolute definition of a sticky tenant. Right behind them is Amazon at 6.5%, followed by major defense contractors like Lockheed Martin and Booz Allen Hamilton. This gives them this incredibly stable, recession-resistant commercial base. It's exactly the kind of bedrock you want when the economic tides start shifting. But here's where it gets interesting. The trouble isn't entirely where you'd think. Conventional wisdom right now says office is dead, right? But for JBG Smith, they're actually facing severe headwinds in their multifamily portfolio. In Q1 2026, their same-store net operating income, or NOI, for apartments plummeted 9.1%. This drop was driven by higher expenses and slightly lower revenues, mostly due to new supply in the area and federal job shifts. By comparison, their commercial same-store NOI only fell 3.2%. And their reaction to this data has been seriously bold. They are aggressively redeploying their capital. Check this out. They sold off a huge development parcel in Potomac Yard for $50.7 million, plus an entitled office site at 2100 Crystal Drive for $8 million. Then they turned right around and opportunistically bought distressed office properties. They snagged Dulles Plaza for $42.3 million and Dulles View for $31.5 million. It's a highly calculated, totally contrarian bet. They're wagering that their multifamily assets have hit a short-term ceiling, while commercial office space, at least in their specific government-heavy submarkets, is severely underpriced. Let's pivot to Section 4, Dividends and ESG, looking at shareholder returns and sustainability. Now, if you're an income investor, the dividend is obviously your main focus with a REIT. In Q1 2026, the board declared a quarterly dividend of 17.5 cents per common share. Though you really need to note that their payout ratio, based on core FFO, has been bouncing around a lot lately. Just for example, they paid a 35-cent dividend in Q4 2025, which basically represented a 90% payout ratio of that quarter's core FFO. So if you're watching this stock, you have to monitor these distributions like a hawk, as management tries to balance rewarding shareholders with the absolute necessity of servicing that $2.48 billion debt load. Beyond the payouts, they keep a really tight ship when it comes to corporate governance and ESG standards. They actually use third-party verified emissions data following the strict ISO 14064-3 standard. Strategically, they focus heavily on transit-oriented urban infill projects, which just naturally lowers transportation emissions for everyone renting there. And on the social side of things, they manage the Washington Housing Initiative Impact Pool, investing heavily on behalf of third parties to preserve affordable workforce housing right in their core markets. And that brings us to our final section, future catalysts and innovation, specifically the National IQ Hub. So in February 2026, an absolutely massive development dropped right in their backyard. The National Innovation Corridor, or National IQ, was officially launched across Arlington and Alexandria. Now, this is a specialized innovation district built specifically to bring together government, academic, and the private sector to tackle challenges in national competitiveness and dual-use tech. And since JBG Smith basically owns the real estate in this exact corridor, National Landing, they are sitting right at ground zero of this massive new economic engine. But the real kicker here on this slide is the sheer weight of those founding partners. JBG Smith isn't just the landlord, they are a founding partner, right alongside heavyweights like Amazon, Northrop Grumman, SAIC, and Virginia Tech. By providing the physical platform for these tech and defense giants to collaborate, JBG Smith is essentially engineering its own massive future tenant demand. They're cultivating an ecosystem where defense contractors practically have to rent from them just to be in the room where it all happens. It's brilliant. So the ultimate question you have to ask yourself as an investor looking at this is, do the current risks of those multifamily headwinds and that huge debt pile outweigh the massive upside of their contrarian office bets and this brand new National IQ Tech Hub? Yes, JBG Smith is trading at a steep discount to its book value right now, but it takes serious patience to ride out a pivot like this. So are they a visionary buy, perfectly positioning themselves for the next giant wave of defense tech leasing, or are they just a value trap in a high interest rate world? That is the multi-million-dollar puzzle JBG Smith presents today. Thanks so much for joining this explainer, and I hope this deep dive helps you navigate the incredibly fascinating dynamics at play here.